Alrighty, people, let's get serious here. What happens when you miss the bounce? The one that we were preparing for. And we see things like Nvidia going up 6% on the day and all the big mega cap names are ripping to the upside after taking some heat early in the trading year. So we're going to talk about that on today's Stock Market Brief show. Some very key specific levels. I mean, very key specifics. We're going to go into anchor VWAPs on Google, Tesla, Apple, Amazon, all the big market cap names. We're going to go into some signal charts. We're going to go over into some new gamma levels and much more on today's episode. I want to first do a PSA, public service announcement, the swing trading community that I offer on Patreon. Now, I don't post anything on Patreon. I post it all on Discord, but you sign up through Patreon because they handle all the billing and all that stuff. That's why I don't have a website that does this, because they take care of it all for me. I charge a whopping $9 a month. You can pay annually and save 16%. So $9 a month and you get access to my entire watch list. I update it basically weekly, and I even extract the names from my watch list and call it the tight list, the TL, and I give a PDF of quick little charts in there. So, I mean, even scanners out there cost more than that. We give trade ideas, or I give trade ideas, I should be more specific. They're not alerts. This is not an alert service, okay? So don't come in here with the mindset that I'm going to tell you when to buy, tell you when to get out. You need to manage your risk. I just give some ideas, and basically this year, the ones that I've been trading, I posted my P&L just today, and my portfolio on Twitter. Every single trade that I've taken has basically been in the trade ideas section, except for like one, which was a large market cap random name. Okay. Then we continue on. We also have, I give you the zones. I give daily, expected moves, weekly, monthly, and all that stuff. And you have access to the community. Enough of that. All right, let's take a look here at the market view. We're looking at a bunch of different sectors. We're looking at some indices, ranging from Bitcoin all the way down here to oil. And we're looking at this column more specifically, the percent change, and that is on the daily percent change. Okay. Oops, what am I doing right there? I wanted to call out because we've been talking about these two assets, both the dollar and the 10-year yield, and how important these intermarket assets are, that we've noticed a strong negative correlation, that when the dollar drops and the 10-year yield drops, doesn't mean that this correlation always has to hold, but that's what it's been doing. You typically see the market do quite well. And well, what did we see do pretty well? Well, we saw the markets in various sectors do very good, okay? Go figure, right? So if we continue on and we look forward, if we start getting movements higher in the dollar, or if even the 10-year yield starts to level out or move up, that could bring back in some more mixture, obviously, as far as performance goes. Now, when we look at how the day progressed today, and you look at the 11 sectors, tech led the way at 2.51%. Consumer discretionary was up 1.7%. These two right here are really risk-on type assets. Even consumer staples and utilities and even healthcare, those are more safe assets, but they were also up almost 1% on the day. So those are still doing very well, which we have discussed on the prior episodes this year. The NASDAQ composite was up 2%. The S&P 500 was up a whopping 1.41%. These are two sigma moves, people. These are large moves getting outside of their weekly expected moves. If you don't know what that means, we'll talk more about it a little bit later. Okay, but everything pretty much across the board, including the NASDAQ 100, up on the day. Obviously, the VIX was down a little bit. Now, we talked about the heat map just when we opened up. Pretty much green across the board. Energy was down. Go figure, right? The 10-year yield came off a little bit. There's kind of a tight correlation between the two, but oil really got clobbered today, and we'll pull up that chart a little bit later. If we look at year-to-date performance, where does that put us on a year-to-date basis? Well, still year-to-date, we have healthcare leading the way up 2.91%, and utilities 2.64%. Now, this is one that we talked about going into the new year and how the yearly chart looked pretty well. So this is holding up still as it stands. So pretty good. You got utilities there too as well. And that's, more of a risk-off type sector than consumer staples. Toward the bottom of the list, go figure, right? You have technology and consumer discretionary. So when you look at the daily performance, right, these were the big standouts. But when you look at year-to-date, well, they're still at the bottom of the list. Okay, it's down 1.94% on the year and 1.82% for consumer discretionary. Why is that? Well, they took a big beating, and now they're starting to see a little bit of just a reflexive bounce. So we got to be aware that, hey, does this mean that the bull market's going back? Is this what it is? No, Apple cracked outside of its weekly expected move by like 2 or 3 standard deviations last week. So we're seeing a reflexive bounce right now. We need to see what happens after, and we're going to get very specific on levels. So if I look at year-to-date performance For the S&P 500, it looks very dull, right? A lot of gray on the board. The green one on the board is NVIDIA, and that was really from today's performance, a big standout day. But Apple is still down a whopping 3.62% on the year. Microsoft's rather flat, so dull. Google's rather flat, kind of dull. Amazon's down 1.87%, just a little bit, right? And then we have Meta that's up there too as well. So overall, I mean, it's a pretty dull looking performance. So we got to just be prepared if we're going to continue to see a liftoff and follow through from 2023, or if we're going to, potentially see more of a consolidation or pullback, right? So when I said we had a 2 standard deviation move, I mean, we on the S&P 500, these were the daily expected moves going into today. Look at this. Look at the move. Boom. Very, very, very strong one-way performance. And you can see that during the market net flow the entire trading session. You had the green line above the red line. The red line was below the zero line the entire day, and you were in convergence the entire time. Okay. Now I don't, on my Discord, by the way, if you want to pull up market net flow, you can do that. There's a command in the query section, in this section right here of Tradie Ticks. I offer the whole Tradie Tick suite, and you could type in the market net flow code, which if you look at the help me file, it's there. It just doesn't show you the convergence indicator. It shows more of a momentum one, but you can see here, this was just a steady bullish flow. And you can see here on the price action, steady bullish flow. Now, what do you notice? I'll tell you right now, you don't see any sort of consolidation. So we're going to need to see consolidation. Does this mean it could press up higher? Absolutely. Typically, when we close at the high of the day, you can typically get a push higher into the next day. But as we stand right now, we're actually outside of that weekly expected move. So the likelihood of coming back in, at least at some time this week, remember, it's only Monday. We have a lot of time left and a lot of reports coming. We're not too far off the all-time high. So that's also in striking distance there too as well. 5-day moving average is still declining at this second, but it's starting to curl up the longer we stay above. So I'll give you my kind of layout of what I'd like to see a little bit later in the show. You can also see here on Bookmap. I like to use Bookmap trading software intraday because it gives me an idea of where orders are hiding out. But take a look here. This is right now. This was in the morning, right? So we're at 6:30 in the morning. We open up, Pacific Standard Time, and we start to see a move. And all of a sudden, we got these just massive like bids under the market, and this thing just set us off on a tear. And we didn't quite fill this bigger order up here at 48.07. I just wanted to call out that, even after the market has closed, those orders are still here. To see that, filled at 48, we'll call it 48.08. That seems likely. I mean, the market's almost there, so I feel like that area of liquidity will probably get absorbed. If we take a look at the daily zones, these are this is only a portion of the document, of the visual portion of it that I give to, we talked about it on prior episodes. I'm not going to get too much into that, but you can see that we were at the lower ranges on many assets, right? So VIX, go figure, it was at the upper end, while SPA was at the lower end of its band. The 10-year yield was up at the higher end, and then you had things like high yield and TLT towards the bottom. So what happens? Well, things get extended on one way. You're aware that they're, from a fractal perspective of what's taking place in the markets through various different assets, and we bounce from those levels. Now we're above the midline on S&P 500, and these midlines can sometimes act as areas of support. Okay, and we're about 1% from the upper edge of the band, but remember, these bands are dynamic. They're constantly changing. So what can really get this market to shake up again? Well, we have earnings. Hello. We have big banks reporting on Friday, like BlackRock, right? We got Wells Fargo, Citigroup, JPM, BK, Bank of America, and UNH. And I wanted to call this out because actually, when I look at the financials, even when I was doing my scans to pull up my tight list and all this stuff, like there was so many financial names that look pretty good. And, I'll just show you like the KRE, for example. So the KRE has been on a monster move, right, going into 2024 or, closed off a little bit here in December. And this right here to me is just boom, boom, clear as day. Nice bull flag. Are we going to get continuation and break out? It's a possibility, right? But if we start breaking back down below 51, then it might need some more room. Now, these are regional banks, right? The smaller banks. So if I pull up BKX, these are, larger institutions, and you can see this is also kind of just going sideways. This, it looks pretty good. This kind of looks like a chart of Goldman Sachs, but you get a move up, you get a consolidation, you break out, you get a consolidation, you break out, you get a consolidation, right? And we broke out, and now we're getting a little bit larger of a consolidation as it stands right now on the BKX. So these financial charts, they look pretty good. It's just we're coming into, obviously, a pretty binary event. And when I look, not at all these charts, but when I pull up something like JPM, right? This is one of the larger ones, right? Jamie Dimon. Just take a look at this. Look at this chart, JPM. This to me, I mean, I wouldn't touch this going long right now. I mean, this thing has been completely vertical for a while, and if you missed it, I mean, you want to see consolidation, and then you can play into it, or some sort of a pullback. But as it stands right now, I mean, this thing has been this feels like just an algorithm just constantly attacking and buying and buying and buying and buying and buying and buying and just driving this thing higher. And the only thing that this reminded me of was Apple, and I'll show you what I mean. Apple in 2023. Basically in March when it really started, we got a little extended there and pulled back, but just look at this kind of algorithmic flow, and then earnings came, right? And then we cracked down, and then we saw bouts of volatility since that point. So we had this drive that was basically one way, very shallow pullbacks, and then all of a sudden we got the volatility coming. And I feel like that's going to be a very similar situation. So even if we push up higher, that doesn't change my mind. It's if we start really breaking down from this trend, and then we see the volatility or the consolidation take place. Okay, if you take a look at what's going on for the remainder of the week. Today we had Bostic's speech. Okay, we had him come out. So we have some Fed speakers, right? Fed tomorrow, but nothing too crazy. These are considered like 2-star of importance: balance of trade, exports, imports, and so forth. Okay. Wednesday also we got Fed Williams. And then some oil stuff coming out too as well. It's Thursday and Friday that have the bigger macro data drop. So not only do we have core inflation data, and that's going to be heavy reliant to pay attention to because of, what's the next move for the Fed? What are the markets going to price in? And so it's going to be important to watch that, because really what the market's pricing in is a little bit different than what we've been hearing the Fed talk about. The market is pricing in 6 rate cuts, right? So here's January. They're basically saying there's a 94% probability. They're going to hold it the same. So January priced in, we're going to keep it where it's at, 525, 550. However, going into March and the remainder of the year, you got 1 cut, 2 cut, 3 cut, 4 cut, 5 cut, 6 cuts. Okay, so the market's pricing in, hey, we're going to move rates down aggressively fast. And right, that's only down to 3.75, which if you look back to the left of a chart of a federal funds rate, it's still up there, comparably to years of it being at basically zero. And you take a look over here at the 10-year yield, the 2-year yield curve, and the 10-year 3-month. This thing is still inverted, and these are typically the best indicators of future recessions to come, which we've discussed in prior episodes. What that means for the markets, I don't know, but it's just something to be aware of. Like, hey, yeah, the markets look good, especially after today and overall, right, in 2023. They did too in 2008, right? They did going into the great financial crisis. They were hitting all-time highs. So the reason why I bring that is not to get you paired up. It's to just make you aware that we still have a negative yield curve, right? Inverted yield curve, I should say. And when it gets uninverted and when they cut rates, it's typically not the greatest time for the markets. And if you look at something like oil, we discussed earlier, that was a big crack. So what is oil signaling to us right now? And we talked about the head and shoulders pattern. We talked about the measured move and how it could potentially bounce. Well, it bounced up, it flagged, right? We came back down and tested again. Now we're getting a little bit of weakness. So if we start closing down here, I still think that oil is really kind of just sideways, but it must be really signaling something if we start breaking down through that 65, 64 range and we start to see it hit a little bit heavier. That to me is just price. It's signaling a recession to me. And like I said, what that means for the stock market, I don't know. But if you look back through history, which we have in other videos, it's not the greatest thing. Now, the reason why I brought this up was because what is the market going to do when we get that data? And I did notice something interesting. When you look at January, right, we already talked about the 525. These are the comparing, a month ago to a week ago to a day ago into current. And you see clearly, it's pretty much solid that we're going to hold rates where they're at, despite something crazy happening between now and January 31st. Okay. But then when you look out to the March meeting, the probabilities of a rate cut are obviously, higher, right? To reduce it 25 basis points. But what I've noticed was if you look at, 1 week, 1 day in current, this is actually the probabilities of the rate hike cut are decreasing, and the probabilities of a rate increase or keeping the rates the same, I should say, are increasing. So as we get this data, if this starts to overtake this and get some more 50-50, it doesn't look like the Fed may cut, which the market has priced in, and that right there can bring in obviously some more volatility. So how do we prepare if we get some more of a pullback, and if this is just like a little fake out move? Let's map out those levels. Okay, we're going to look at the mega market cap names, because the mega market cap really can have a big impact on this market. So we'll take a look at something like Google, and I'm going to apply some anchored VWAPs. The anchored VWAPs are at swing highs and the year-to-date swing lows, and then I have the year-to-date anchored VWAP, and I have a 5-day moving average, and they're all on the 15-minute time frame because it allows us to see potential changes in trend on the shorter time. And as you can see today, we had a one-way ticket. So we got to be patient, right? It could still continue to push, but you need to wait and be patient for a consolidation, right? Even if it pushes up here, boom. Okay. Well, what happens if it does this and consolidates and does something like this? What you'll notice is as price holds up higher, the 5-day moving average is going to start to curl up, which is positive. The year-to-date low anchored VWAP will continue to move up. And then also we have this prior swing high anchored VWAP, which we're currently above, will continue to go like that or something like that. And this would allow us, even if we miss it right here and you get all FOMO'd out, there will be a consolidation and there will be a time where we try to reconnect or get close to those levels. And that's what I really want to pay attention to. So if we don't continue to push up and we start to move down, to keep an eye on the year-to-date anchored VWAP. When we're above it, that's pretty bullish. Now, as it stands, the 5-day moving average, it is still declining. So if we were to pull back, all right, in this week, I would be paying very close attention to this area of confluence. The area of confluence here on Google is the year-to-date low, the year-to-date, and then the 5-day moving average, all kind of coming into confluence here. So if the market wants to eventually come to a consolidation or pull back, this would be a level where you'd want to see price find strength at, and then you buy into that strength, and that could potentially create an opportunity for a stronger move in an asset like Google. Okay, so I'm going to go a little bit faster now because there's a lot. These are the Mag 7, but take a look at Tesla. Tesla is not showing as much of strength, so it's pretty much going sideways if you just look at price action alone. Here's the year-to-date anchored low, and we're above that. Now, where's price finding resistance at? It's finding resistance today at a declining 5-day moving average and a year-to-date anchored VWAP. So if we get above this, opens the door to about 245, the prior swing high anchored VWAP, which we have not tested yet. And I think that's a very possible situation if we can get above and hold. Now, this is still declining, so the trend still is down. So if we fly off, right, consolidate, you want to have it to hold the 5-day moving average, and you want it to hold the year-to-date anchored VWAP, and then you could buy into the strength or even wait to see how it works and see if it pinches between these two anchored VWAPs to create a kind of an explosive move outside of that from a bullish standpoint. Now, if this is a fake out move and we're going to continue to go down, well, let's just say if it keeps below the year-to-date anchored VWAP, be on watch. And if it starts getting below the year-to-date low, also be on watch, right? It's as simple as that. It offers small risk to potential large upside. Take a look at Apple. Apple saw a pretty explosive move. We were actually talking about the positive divergence between the lows and the RSI that we're building and this little trend line that was kind of forming like such, or it was like this, I think it was. And then we broke out, we came back down. Okay, so we anchored a VWAP to the low. It actually tagged it, and we've been kind of pushing from that area. Now, this is all in confluence, okay, with a year-to-date low, and then the declining 5-day moving average, which it is very well declining. So if we want to get continued move to the upside, there is obviously, we have, an area of resistance up here. We have the year-to-date high, and then we have the prior swing high anchored VWAP there too as well. But remember, this is still declining, so what you'd like to see, boom, if you watch it push up higher, you want to see this start to curl back around, right? And then the year-to-date to hold, and then this year-to-date low to hold, and then you'd want to see price pull into it and find strength from it, and you buy this strength out of it to give you a better entry and risk to potential reward to the upside. That's how you get a little bit more tactical in this trading environment, because overall, right, the short-term trend is down. You're just getting above the 5-day moving average, which is currently declining. And you can see we got above it here multiple times. And what happened? Well, we broke down, we tried to come back up, and we broke down further, okay? Now, as I've stated many times, but I'll state it again for people that are new, markets, they move between 4 different stages. They move through an accumulation phase, a markup, a distribution, a decline, and then back to the accumulation phase. And this is, you could look at Price action itself, you can look at 200-day moving averages, but just know that if you're looking at a large cycle, you can't ever show me a stock that doesn't go through these 4 stages. They all go through it. This could be the 200-day moving average, but within that, there's smaller trends too, smaller cycles, okay? And that's why we're looking at potential changes here with the 5-day moving average. We're playing the shorter term because the short term has to change in order to change the long term, right? So if, for example, the short term, if the long term is down, you're going to have the short term turn up in order for to eventually change the longer term trend. All right? And then as it stands right now, the longer term trend is technically still up. It's doing good from the prior year. And what we're seeing right now, if we were to draw that out, here's a longer term trend, and I'll just go to like a green color. Right now we're doing this, right? Let me draw a little boom, boom, boom. Right now we're pulling back in an overall uptrend as it stands in this kind of like current environment, just based off just the 2023 price action, all right? If we take a look at Amazon, we'll continue on. Amazon, we have that declining 5-day moving average. You can see we flagged actually, kind of held as resistance on that declining 5-day moving average. The year-to-date kind of fluttered around there. Now we're back above the year-to-date or above the year-to-date low. And then that prior swing high, we're not too far off of that. So that would be the potential area of resistance. If we consolidate, we pull up, look for these to start turning around, be patient, wait for them to turn, right? And then look for them to kind of reconnect and then show strength from that point if you want to be more tactical. Now you can jump in blindly and maybe get a push up higher, but just be aware that if that acts as resistance, potential resistance turns into real resistance, and then all of a sudden we come down like this, okay, you're stuck in a trade, and then you're hoping and praying that it comes back up, okay? Whereas, if you were to enter here, you'd have to look for, hey, where would be a potential area where you can have a stop? Could be today's low, could be this prior pullback low, okay? So there are ways to do it and to position yourself, but if you want to get a little bit more tactical, you wait for the trend to be in your favor. Okay, I'm saying a lot, but it's all valuable if you're really looking to get better at a shorter time frame, being tactical. A shorter time frame could be, by the way, a month, 2 months, 3 months maybe. Could be a week, all right? Take a look at Meta. Meta's also just kind of squeezing itself up higher. It's above this prior swing high. It's above the year-to-date. It's above the year-to-date low. And the 5-day moving average is starting to kind of turn around here. So take a look. We broke through, right? What happened? What happened here? We consolidated. We didn't pull into these levels, but it started to, well, it's still declining at this time, but this anchored VWAP, which was an important one from the swing high, it tells us that the average buyer, based off of this time and volume, was underwater. And when they got above it, right over here, that tells us that now the average buyer since that point right here is actually in the green. So the psychology changes. And well, we pulled back right around into that area, and guess what? We took back off like a little flag pattern, and then we blasted back off. So that gave us, it's a good little move there. Take a look at Microsoft. Very same situation, right? We came into the year-to-date anchored VWAP. It was declining 5-day. We kind of just consolidated there. We got above it, and now the longer we stay above it, it's going to start to curl back up. The year-to-date anchored VWAP is rather flat, but it's starting to move up, but we're above it, which is positive. Price is above the year-to-date low anchored VWAP. And the 5-day moving average, if price can hold up in these areas, it's going to start turning back up. Positive sign, wait for the consolidation, be patient, and then the setup will come. If you chase these types of moves, right, if that's your strategy is chasing a move, you will get lucky sometimes and it'll go high. But there will be times that if you chase the move, you will get smashed. That's just how it is, because there's not if you enter right here, where do you put your stop loss on this time frame? You might say, well, I'll put my stop loss here. Okay, well, that means that's one risk unit. So you need to have from here, go all the way up, to 400-ish to be like a 1-for-1 risk to reward trade. Wouldn't it be better if it went up, consolidated, then you played the strength breakout here, and then you risk this to get to the 400? It would just make more sense because you'd be risking one unit to potentially get, close to 2 or so forth. That's just an example. Take a look at NVIDIA. NVIDIA was the strong one today. We got above that 5-day moving average, started to kind of flatten out here, and above the year-to-date anchored VWAP. Now, I want to show you what this looks like. So the year-to-date anchored VWAP, we got above it, and what happened? Well, we consolidated, right? You might have FOMO'd, you might have not, but it came into where? The year-to-date anchored VWAP. Then we went for the run above the 5-day moving average. What happened after that? We consolidated again. This was turning up. This was starting to flatten out. And that right there, like I said, this gave us a little flag pattern, right? Expansion leads to contraction. And that gave us this breakout moment, getting above this high, and we just saw a blast off type of move on this time frame, and the daily and the weekly look pretty good too. Now, we talked about the possibility of a bounce. One of the charts we shared was how price action was coming into the inclining 5-weekly period moving average. And you can see how to start the week off, up 1.41%, not too shabby overall. And the 5-period moving average right there is still inclining. There are a couple of potential changes in trend here to be made aware of. We had the parabolic SAR tick over the summation index, and that is not necessarily a good thing. It's marked periods of consolidation and pullbacks, right, in the market too. So that happened in the NASDAQ summation index, despite seeing today's bullish price action. And that happened in the NYSE summation index there too as well. If we look at the old fool indicator, we had the green line cross above the blue line. This is looking at the NASDAQ composite divided into the total put to call ratio and applying a couple of moving averages, EMAs. And when the green line goes above the blue line, that can act as a buy signal. And we saw the move. Good. We're still on a buy signal. It's starting to curl over. So we'll see here if we get the sell signal. This is a lagging indicator, right? It's very lagging. But it has identified longer trends. So for example, the last sell signal was right here, right? The market already moved down quite a bit. Then it started blowing up into, the opposite direction. Well, it was still on a sell signal. Well, what happened? Well, we started moving down and we started moving down. All right, so it's not perfect. And then we had the buy signal here, but we saw a big move already. Okay, so it actually triggered over here, and then we started to see this strong move from that point. Okay, so it's lagging, and we can use other things to help us kind of get a little bit more fine-tuned, but that is what that looks like. Now, if we take a look at the new daily expected moves for the SPX, the S&P 500, we're looking at 47.85 to the up, 47.41 to the downside, and we are trading outside of that weekly expected move. And once again, not too far from striking distance of the all-time high, which seems like that, feels like we can get there at some point. We still have that declining 5-day moving average. Now, let's show some gamma exposure levels. The big one is going to be at 4,800. This is S&P 500 using OA and DA. If you're on TradingView, this allows us to see continuity. So it's more flow. You can use either chart and you can apply these levels. But for example, 4,800 has been tagged in the overnight session already that we've seen on this specific chart, but we just didn't see it happen, obviously, on the SPX, which it doesn't have the continuity if you pull that one up. So local support going into tomorrow, 4760, local resistance, 4800. And then we are in that positive gamma territory right now, and that's at 4709. So not only are we in positive gamma territory, we're also above the 5-day moving average, which is starting to curl itself back over. So now we just got to wait to see if this digestion takes place at some point, and if that sets up more trades, right? It's positive to be in positive gamma territory. That's where dealers look to buy or sell into strong moves and then buy into the dips. And so you get to see, kind of nice grind up higher as volatility kind of subsides a little bit. But when we're in negative gamma territory, that's where we look, sellers sell into selling, dealers sell into selling, and they buy into buying, which creates a lot more volatile price swings. If we take a look at the Qs had about a 3 standard deviation move today, coming way outside of the weekly expected move. So very similarly, I applied the anchored view up to the upside, anchored view up to the downside. You can see the year-to-date acted as resistance, got above it. Okay, and that's starting to turn over. So we're bullish when we're above the year-to-date anchored view up and above a rising 5-day moving average. As it stands now, we're bullish, but with caution, just because we want this to start turning back up. So if we start pulling back down, wait for the consolidation, look to see if we get strength and follow through. Okay, that's even saying if we start way up here tomorrow, be patient, right? Be patient, wait for things to consolidate, because that is a strong move, and the strong moves, they do eventually get digested at some point to allow for better entries. Like I said, that's not financial advice. It's just what I do personally. We take a look at the SPY, also outside of that weekly expected move, and we're above that 5-day moving average. And you can see here, there is some confluence up in this area. So if we start pulling back into these levels, perhaps we find some continued strength. If, from a bearish perspective, on anything that I mentioned, we start getting back below the year-to-date, back below the declining, back below the gamma flip line, and so forth, that's when we obviously pump our brakes and we could just be in for ourselves for a bear trap. But so far, so good. That's all I got for you on today's episode. We discussed a lot. Download the chart deck if you want to download it. It's free, and you could get these levels on your charts as well. See ya.